I'm a young investor and don't know where to get started. How should I build my portfolio? This is a comment I came across in one of my videos. I wanted to cover this topic as it relates to me and I know it relates to many of you out there. Before I get started, I just want to say this isn't financial advice. I'm just sharing my thoughts and experiences to help others learn. You always want to make sure you're doing your own research. When you're a young investor, your biggest advantage is time. The longer your money is in the market, the more it could grow through compounding. Because of that, you could usually take on more risk early on. The market will have ups and downs, but with time, the market goes up. That's been shown throughout history. Myself, being a college investor, starting off my journey, I really welcome risk. I keep it all reasonable risk. I want to know what I'm buying, but knowing that I have the rest of my life to be in the stock market, I'm looking for those opportunities that have big growth and understanding that I might lose some investments. I might lose some money, but in the end, I'm going to learn from these risk experiences. Since you have time being a young investor, your portfolio can be more aggressive. So the way I break down my portfolio, I have about 50% of it in low risk, good opportunities. So I view that as an Amazon or Google. I have about 30% in moderate risk plays, but with high growth opportunities. For example, a company like Nike who's been beaten down, they still have to get back on track, but if they do, I see big growth in the next 5 years. And then I have about 20% in high risk, high reward investments. These are companies that have a lot of work to do, but if they succeed, you're seeing massive growth down the road. And I keep that position small because a small amount of money will go a long way. So one of the biggest keys is diversification. Instead of betting everything on a single stock or sector, you want to spread it out. So by spreading it out, if one area drops, your whole portfolio won't crash. Or where you could run into trouble is, say you have about 75% of your investment into tech stocks. If something happens to the tech industry and there's massive crashes all over, you're going to put yourself in a bad position. So you want to spread it out. You could take more risk by concentrating more into one sector than another if you think there's opportunities. But overall, you want to stay diversified. Now let's go over a few investment options. So you have individual stocks. So these are good if you enjoy research and you want more control. You could find high growth opportunities early, but with that comes more risk. ETFs are another great way to invest. These are great for beginners especially because you don't have to do much research, but they're also good for anyone who isn't a hands-on investor. They offer built-in diversification and track whole markets or sectors, and they're simple, safe, and steady. The third option is bonds. So bonds are lower risk, lower reward. They're not ideal for growth, but they're good for preserving wealth or stability later in life. For me, I prefer individual stocks. One of the reasons is I just enjoy investing in itself and learning all about investing. And when I get to learn about a company and break it down, it feels rewarding to earn that confidence in myself that I could put my money towards that company. I do own ETFs as well. I only have about 10% to 15% of ETFs in my portfolio. That's in my 50% lower risk section. It's more of a stabilizer and a fallback, a way to diversify. But again, I like researching and I like trying to find those growth opportunities. Personally, I'm mostly into individual stocks. Bonds is not something I'm looking in right now. As I get closer to retirement, that's something I will do, but the lower risk, lower reward, and them not being ideal for growth is not something that I'm not interested in. The next thing to talk about is dollar cost averaging. So this means investing a set amount consistently. So let's say you're going to set aside $100 every 2 weeks to invest, no matter what the market is doing. This helps remove the stress of trying to time the market, and it builds long-term discipline. When I first started investing, I already knew about dollar cost averaging, and I didn't have too much money to start, so I spread it out. Looking back, I would have made smaller purchases to start, especially with where the market is today. I would have known we were in a 10 to 15% correction right now with the S&P 500 and NASDAQ. I would have loved to have more money right now to invest, but obviously you can't predict the market. But luckily, knowing about dollar cost averaging, I've been able to spread out my money throughout this dip and throughout this correction. So I'm able to continue to buy and lower my averages for these companies. So when the market does go up, I'm seeing a lot bigger return than if I would have bought 3 months ago. One of the biggest things, and I think probably the biggest thing as a young investor, is you will make mistakes. And that's for all investors, not even just young investors. And that's completely normal. You just want to make sure you're learning from those mistakes. The hardest part of investing is staying calm. You do not want to chase the hype or panic sell during dips, and the long-term mindset always wins. Being young, you're going to have so much time in the stock market, so these small dips aren't really going to mean anything 10, 15, 20, 30, 40 years down the road. They're just going to be seen as buying opportunities. Right now is a moment where I'm staying patient when others aren't. When you see the market at a correction like it is today, you'll see a lot of people panic selling, whereas I just view this as a buying opportunity to buy great companies that are going to be around for years down the road and are going to give me fantastic growth. So times like this are really just a time for you to practice your emotional discipline. And if you have the money to dollar cost average, this is when you do it, in those market correction moments. So to close this up, answering the question, I'm a young investor, how should I build my portfolio? I hope this helped you out. You do not need to be perfect. You just want to get started. Learn as you go, stay consistent, and keep growing. If you've got a long time horizon, small moves can turn into something massive later. As a young investor, you have the time to be risky. 60 years old, close to retirement, you can't be as risky. But especially me and anyone in my situation being a college investor, take on the reasonable risk. And you're going to thank yourself later. Because if they don't work out, you're learning. And if they do work out, you're making money. I just want to close it off at that. If I missed anything, ask me a question in the comments. I'll cover it. If you like this style of video, let me know. I think I'm going to enjoy doing a more, less scripted, casual video such as this one, answering questions. Welcome any questions, any criticism, any videos you want to see. But, I hope you enjoy this video and look forward to making more content.